Hello everyone, my greetings to one and all. This is the second session on money and banking. In the first session, you have learned about the components of money supply. I am Poonam Vohra from Egypt Economics Learning Center, and in this session, you will learn about the entire process of credit creation by the banks. In fact, most of the money in the economy is created by the banks. Rather, the entire banking structure is based on credit, where credit basically means having the purchasing power now and promising to pay it at some time in future. So a bank's credit means providing loans and advances. Banks create credit whenever they provide loans. The loan is credited to the account of the borrower. Every bank loan creates an equivalent amount of deposits in the bank. Therefore, credit creation actually means expansion of bank deposits. And banks can expand their demand deposits as a multiple of their cash reserves. And this function of credit creation separates banks from other financial institutions. So let us try to understand how actually banks create credit. Let's begin. We have already understood that there are two components of money supply: currency held with the public and demand deposits in commercial banks. Currency is created by the commercial bank of the country because it has the sole right of note issue. The currency so created is called high-powered money. Demand deposits are created by commercial banks and are called bank money. Money creation is one of the most important activities of commercial banks. Money creation is also known as deposit creation or credit creation. Out of the total deposits received by commercial banks, they are able to create credit which is far excess of the initial deposit. That is, they are in a position to lend more than what is lent to them. The process can be understood by making few assumptions. First is that the entire commercial banking system is considered as one unit and termed as banks. 2. All payments are made through checks and all receipts are deposited in banks. 3. It is legally compulsory for banks to keep a certain minimum fraction as reserves. This fraction is called legal reserve ratio and is fixed by the central bank. It is also important to keep in mind that all depositors do not approach the banks for withdrawal of money at the same time, nor do they withdraw the entire amount in one go. Also, there is constant flow of new deposits into the banks. To understand the process of credit creation, suppose the initial deposits in the banks is rupees 1000. Legal reserve ratio is 20%. It means banks are required to keep rupees 200 as cash reserves and are free to lend rupees 800. Now the banks lend rupees 800 not by cash but by opening the account in the name of the borrowers who are free to withdraw the amount whenever they like. Now suppose borrowers withdraw the entire amount. Since all transactions are routed through the banks, the money spent by borrowers come back in the form of deposits in the accounts of those who have received the payment. So it will increase the demand deposits of the banks by rupees 800. With new deposits of 800, banks keep 20% as cash reserves and lend the balance amount of rupees 640. Now borrowers use these loans for making payments, which again comes back into the system and are deposited in the accounts of those who have received the payments. This time, banks' deposits rise by rupees 640. So, the deposits keep increasing in each round by 80% of the last round deposits. At the same time, cash reserves also increase each time by 80% of the last cash reserves. Deposit creation comes to an end when total cash reserves becomes equal to the initial deposits. The same process is explained through a tabular presentation. Have a look at this table. Initial deposits 1000, reserves kept 20%, which is 200, amount loaned 800. This becomes the deposits in the next round. 20% kept, which is 160, and rest, that is 640, is loaned out, which became the deposits in the next round, and it continues till the total of reserves, which is 1000 in this case, is same as the initial deposits, which is 1000. So money multiplier can then be calculated by using the formula 1 by legal reserve ratio. Legal reserve ratio is 20% or 0.2, that is 1 divided by 0.2, which is 5. That means the deposits are multiplied 5 times of the initial reserves, which is 1000, and final deposits are now 5000. It implies higher is the legal reserve ratio, lower will be the money multiplier. And lower is the legal reserve ratio, higher will be the money multiplier. Now that you have understood the process of credit creation, assess yourself. 4 options are given. Identify the correct option. Maximum credit that the commercial banks can legally create is indicated by A. 1 by legal reserve ratio into total deposits, B. 1 by statutory liquidity ratio into cash reserves with RBI, C. 1 by cash reserve ratio into total deposits, and D. 1 by cash reserve ratio into cash reserves with RBI. The correct answer is option D. That is, maximum credit that the commercial banks can legally create is indicated by 1 by cash reserve ratio multiplied by cash reserves with Reserve Bank of India. Every bank is required to maintain its reserves with itself as well as with RBI. These two ratios need to be considered in order to decide the limit of credit creation. Now have a look at this statement and identify the correct answer out of the 4 options given. The statement is, an increase in the growth rate of money supply is most likely to be followed by A. recession, B. depression, C. inflation, and D. deflation. It is quite simple. If there is an increase in the growth of money supply in the country, there is an increased purchasing power with the people, and that leads to inflation in the country. Hence, option C is the correct answer. I hope you have understood the entire process of credit creation by the banks. With this, the second session on money and banking gets complete. Keep a watch over the money supply, read newspaper, collect data. Try to analyze the situation. That is the best exercise you can have. So the next session is on the functions of Reserve Bank of India. Till then, keep researching, keep reading, keep learning.